Good afternoon, everyone, and welcome to the Dewan Housing Finance Limited 1Q FY19 earnings call. We also have with us the senior management team of Dewan Housing Finance Limited, represented by Mr. Kapil Vadavan, Chairman and Managing Director, Mr. Harshal Mehta, Joint Managing Director and CEO, accompanied by Mr. Santosh Sharma, Chief Financial Officer, Mr. Vivek Kannan, Chief Operating Officer, Mr. Bharat Parekh, Head of Treasury, and Mr. Pranab Goel, the Head of Investor Relations. Now I would like to request Mr. Kapil to take us through the result highlights, post which we'll open the floor for Q&A. Over to you, sir.
Yep, thank you. Ladies and gentlemen, it's my pleasure to be here with you today. Let me start by addressing a few points before handing the call over to Harshal and the team for their comments. It has been yet again an extremely good quarter for DHFL, following up on what was record FY2018 on most parameters, which include higher disbursement, assets under management, and profit growth. I'm very proud of what the team has achieved, but there is a lot more for us to do. A lot of the structural changes we have made with systems, processes, and management over the last few years are starting to play out fruitfully. Case in point is the record success of our retail NCD issues and robustness in funding profile, improving operating efficiencies, which is translating into lower cost to income and higher trajectory of profit growth. As I had briefly touched upon in the prior earnings call, the robustness in funding profile for HFCs will separate the men from the boys in coming years. We are very well placed, be it in record NCD issuances, scale in securitization stroke assignments, and our ability as a deposit-taking institution, which helps term out the duration of our liabilities, a critical differentiator for any player in this business. On the asset side, DHFL, with its long vintage of data and experience of seeing multiple credit cycles in the affordable segments for almost 34 years, and I must reiterate here something which many others don't have. We are in a sweet spot and will continue this pace of growth in a sustainable manner for the foreseeable future. We have made substantial strides to enhance our distribution prowess as well as back-end capability to maintain robustness. Our CPUs in Bhandup and Hyderabad are live examples of this and should be a must visit for every analyst and investor in the HFC space. Almost 80% of our retail book today is CPUs, which is bringing significant efficiencies as evidenced in our declining cost-to-income ratio. It is our endeavor to bring this number below 20% over the next 3 quarters. On capital today, DHFL's net worth is north of 10,000 crores, which is expected to bolster further with strong profit growth in FY19 and beyond. It is important to note that despite getting the liberty with Ind AS, DHFL has not revalued, and I will reiterate this again, DHFL has not revalued upwards its equity holding in 2 entities which carry substantial value today. Those holdings are 9% stake in Aadhar Housing Finance and 31% stake in Aavas Financial Services. Both Aadhar and Aavas have achieved sizable scale and profitability today, as can be seen in our earnings presentation. Monetization of these investments over the next couple of years will not just provide non-dilutive capital for DHFL, but will also showcase the group's expertise in building robust businesses for the benefit of all stakeholders. I thought I'll just mention some of these important highlights. With this, I hand over the call to you, Harshal. So over to you.
Thank you, sir. Good afternoon, everyone. I welcome you to Q1 FY19 investor call of DHFL. I have with me Santosh Sharma, our CFO, Vivek Kannan, Chief Operating Officer, Bharat Parekh, who heads the Treasury, and Pranab, who heads Investor Relations. As our Chairman, Mr. Kapil Vadavan, mentioned, this quarter has been exceptionally good for us, not just from a disbursement perspective, but also we transitioned from Indian GAAP to Ind AS, and I'm sure you may have many queries around the same. As you would be aware, Deloitte is now a statutory auditor of DHFL. They are also the ones who have assisted us in the Ind AS transition and they have worked extensively to ensure that the transition is executed well. I will let Santosh Sharma run you through the changes that have impacted us and also address queries you may have regarding the same. But before I hand over to him, I'll spend a few minutes giving you an overview of what has happened on the business side. Before getting into the numbers, I am extremely pleased to share with you that DHFL was felicitated with a national award by the Ministry of Housing and Urban Affairs, Government of India, for facilitating the highest number of subsidies under the government's flagship initiative, Pradhan Mantri Awas Yojana, at a glittering event attended by Prime Minister of India, Shri Narendra Modi. This award recognizes DHFL's position as a preeminent affordable housing player in the country. This is DHFL's second national award for its PMAY efforts. Furthermore, I'm also pleased to inform you that U.S. Agency for International Development, USAID, has tied up exclusively with DHFL for providing a $10 million loan portfolio guarantee for DHFL's SME loans to the health sector in India. The tie-up was done after extensive due diligence by USAID, and we are the only company in the country where they have tied up for this arrangement. This again recognizes the expertise we have built in our SME program and also recognition of our best-in-class underwriting standards. Now, to the business update. We have ended the quarter with an AUM of 1,20,940 crores, up 37% year-on-year, driven by strong growth across all product segments. This has been achieved while retaining our focus on low and middle income segment throughout our more than 3 decades of existence. Our home loan portfolio has grown at a strong 23% year-on-year, higher than the 22% growth rate we registered in the entire year of FY18. This implies a strong growth momentum and dovetails with the feedback that we get from our sales team who have their ears to the ground. LAP and SME loans continue to show strong growth, driven by the strong formalization of the economy. We have been seeing their share in the product mix go up in the last few quarters. But as affordable housing picks up with more supply coming into the market, we expect home loans growth to remain strong and its share to go up. In the medium term of 2 years time horizon, we expect home loans to go back to the 2/3 levels from the current 3/5 level. Implementation of RERA, PMAY, and other various government initiatives have had a big role in incentivizing the affordable housing segment, and we have already seen their impact in our disbursement numbers. Overall disbursements for the quarter increased 65% year-on-year to 13,583 crores. Under Prime Minister Awas Yojana, we have submitted more than 16,000 applications to NHB for only one single year, that is FY18, claiming a total subsidy of more than 370 crores. Out of this, more than 150 crores has already been received and passed on to the customers. We expect the total subsidy amount for the year to cross about 600 crores once all the applications are submitted and cleared. We have increased our securitization volumes as well, selling down gross loan assets worth 2,628 crores. Our share of off-balance sheet loan assets is at 17%. We expect these numbers to go up as we continue to sell down good chunks of our loan portfolio. As our chairman mentioned, our net worth for June 18 under Ind AS has gone up north of 10,000 crores as against 8,796 crores under IGAP as on March 2018. This is mainly on account of released deferred tax liability on special reserve and the incremental impact of upfronting of income on direct assignments. However, we must state here that this increase in net worth does not include any fair valuation of the stake that we hold in our group companies, predominantly Aadhar Housing Finance and Avance Education Loans Company. So in future, whenever we decide to monetize these stakes, that benefit would flow into DHFL. The strong business growth along with the strategy of healthy securitization has helped us ensure that our NIMs are at a healthy 3.44% in quarter one vis-a-vis 3.31 in quarter one of last year. This obviously take into account the accounting changes post-transition into Ind AS. We will look to maintain NIMs in the similar range and protect them going forward. A year back, we started our journey of consolidating the back-end operations by setting up two central processing units in Mumbai and Hyderabad, which our chairman touched upon it, so I'm not going to talk more on this. However, with close to 80% of the loans getting processed at CPU, some of those impact has started showing in our cost-to-income ratio. And we are pleased to say that our cost-to-income ratio has come down to 21.4% in quarter ending June 2018, vis-a-vis 21.66% in quarter ending June 2017. Do note that this takes into account the incremental impact of fair valuation of employees' share-based remuneration in employee expenses, which is ESOP expenses, under Ind AS in first quarter. If we take that out, because we consider that as a part and parcel of our compensation package to our employees, if we take that impact out, our cost-income ratio would have been at 18.92%. Notwithstanding that, we continue to be guided by our chairman to bring our cost-to-income ratio below 20% levels and continue to work on improving it further. I have informed earlier during previous quarters of our pioneering concept of Grey Utsav or home festivals in Tier 2 and Tier 3 locations. These Grey Utsavs help us not only in consolidating the DHFL brand in our target locations, but we clearly see a strong uptick in the business from all such locations where we held these events. We hosted 31 such events in the entire last financial year, and I am pleased to share with you that we have already hosted 23 such events in just first quarter of this year, and we are on track to cross our internal target of 100 crores in the current year. First quarter of this year was also a superb quarter on the liability side of the business. We came out with our third issue of retail NCD issue and garnered 11,000 crores through this issue. On top of that, we raised $150 million through our first masala bond issue. Overall, we raised nearly 13,000 crores of long-term money in the debt capital markets in one single quarter. You can see the impact of this on the liability mix, where the share of debt capital market has gone up from 40% in quarter 4 of last year to 48% in quarter 1 of this year. In addition to this, on the liability side, the fixed deposit book has grown at 35% year-on-year to close to 11,000 crores and currently accounts for 10% of total liabilities, up 8% from FY17. A combination of debt capital market borrowings done in this quarter, higher securitization, and strong growth in FD provide us with enough ammunition to grow the loan book while maintaining a tight control on cost of funds. We will continue with our strategy to diversify sources of borrowing and also optimize for a combination of liquidity and lower rates. The success of our strategy is evident as our cost of funds have remained flat in a rising interest rate environment. And we closed first quarter with an on-balance sheet cost of funds of 8.46. However, on the asset side, we have taken 3 rate increases since April 2018, totaling to a total repricing of 62 basis points on the entire book. The last one, a 25 bips hike, is effective from 10th of August. As rate hikes are prospective in nature, the full impact of financials come with a lag. The asset quality continues to remain strong with a gross NPA of 0.93%. I would like to end by reiterating that the journey that we started more than 2 years back on improving our cost efficiencies and reducing the cost-income ratio continues to be on track without losing the focus on the core segment, being the low-middle income segment, resulting in cost efficiency which is improving steadily. I would now like to hand over to Santosh Sharma to run you through past the accounting changes. Over to you, Santosh.
Thank you, Arsin. Good afternoon, everyone. I am sure by now you have a fair amount of understanding of Ind AS regulations. So I will focus more on how the new accounting norms have impacted DHFL. I request you to refer to slide 6 in the investor presentation, which lists the major changes which have impacted DHFL. Our loan assets have been classified under 3 stages, and the provisioning is done based on the expected future credit losses as prescribed by Ind AS. These provisions have been made on the basis of the company's historical portfolio performance as also various other factors. Under the effective interest rate accounting, now DSA commission and processing fees are amortized over expected loan tenure and are part of interest income. However, do note that the processing fee on retail loans is taken upfront, the reason being that these are taken at login and not linked to sanction or disbursement. Similarly, operational sourcing costs not linked to specific disbursed loans are also charged upfront. On the liability side, the main difference is on account of redemption premium on zero coupon bonds, while under the earlier accounting norms, a part of the redemption premium on zero coupon bonds was accounted for through the reserves. Now the entire redemption premium on ZCB is passed on through interest expenses line in the P&L statement. Another big change is that under Ind AS, the NPV of future excess interest spread on direct assignment transaction is now accounted for upfront in the interest income. This dovetails very well with the strategy that we have been following for past many years of selling down large amount of loan portfolio, which Harshil has already given the good amount of data. While this can lead to some volatility in the income for a particular quarter, depending on the volume of sell down in that particular quarter, overall we would continue to maximize the sell downs, which have the additional advantage of releasing the entire capital on the sold down portion, as also passing on any credit losses to the buyer. There is also a big change in employee expenses on account of share-based remuneration given to employees. DHFL issued employee stock appreciation rights to employees, and the latest details of the same are given in Annex 4 to the board's report in our FY18 annual report. While under the earlier accounting norms, ESAs were accounted for under intrinsic value method, under Ind AS we have transitioned to the fair valuation method, and the impact of same is charged to P&L under the employee expenses. The last major impact is on account of deferred tax liability on special reserve, which is now not required under Ind AS, and the earlier DTL is reversed. These are the major items which have had an impact on the financials in this quarter. A detailed reconciliation of the same for Q1 FY18 is given in slide 7 of investor presentation. After accounting for all these changes, our revenues for the quarter grew at 26% YOY to rupees 3,156 crores. NII was up 35% YOY to rupees 831 crores. driven by an interest income growth of 24%, which was higher than the interest expense growth of 20%. Assets in stage 3, which is 90 plus DPD, was at 0.93%, in line with what we reported in earlier quarters. Our total provisioning under Ind AS is at 107.3%. Our profit before tax increased 43% YOY to rupees 638 crores for the quarter, and PAT increased 35% YOY to rupees 435 crores. Now we will open the floor for Q&A session. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Digant Haria from Antique Stock Broking. Please go ahead.
Yeah, hi team. Congratulations on this fantastic performance. Sir, especially this home loan part growing at 23% is very, very encouraging, because we see that a lot of these regional housing companies are struggling to even grow at 10%. And so as you said, we visited Surat and saw what DHFL is doing. So we just wanted a little more flavor of what are we doing on this home loan, specifically on this home loan front, and what we think the next 2 years in this space can be for us.
See, Digant, overall, when you look at it on the home loan, see, the focus continues to be in this segment. Now, how do we make sure that this segment continues to give this opportunity is by way of identifying certain what you call as roadblocks in terms of smoother processing. And that is something which we continue to keep on working on it, because that is the only way it gives us an opportunity to go deeper and into the markets and reach out to that segment. So while CPU is one of those things which we have showcased it to research analysts like you and who have been seeing that, but the focus continues that using that technology, how do we make it accessible to that segment and reach out to those guys by able to process the loans faster. One thing which has come out very clearly by the extensive travel which all of us have done is the demand is inherently very strong. But somewhere in the journey from that location to the processing, it takes a lot of time, and it gets lost out in middle. And that is an area where we are constantly working on and take that product. In fact, as a matter of fact, some of the things which we have already launched is with our sales guy on the app, which we call it as which we have nicknamed internally Dost, which is nothing but a chatbot. But that gives a power to my front line, even not in a district but in a taluka level, to actually able to tell him virtually at 70% confidence whether his loan will go through or not, depending upon what the documents he gives us. Now, this gives us tremendous amount of confidence of taking the home loans into the hinterland of this country at giving a superior experience without really having to spend a bomb around this. And this is a strategy which we are constantly working on to say that how do we ensure that for the next 2 years we cover ourselves with the right amount of growth and reach out to those markets.
Right, sir. So that's very good to hear. So my second question is that especially in these developer loans, I understand that we try a lot to structure it in a way that at least our position is secured, and we try to select projects in a way that they don't get stuck. But sir, now at least what we see is that Mumbai market and especially Delhi NCR, some markets are the sales velocity is so low that even the best kind of structuring would come under a little bit of pressure. So are any thoughts on this particular part and where DHFL stands in this whole whole macro backdrop which is there?
Yeah. So on the project finance, see, the good thing is that we don't have any exposure in NCR. Okay. So to that extent, we are well covered by saying that look, we are not present there. Now, when it comes to Bombay, the projects which we have selected or where we have gone ahead and lent are those where we see good amount of traction, and we also see good amount of velocity on that. Because again, these are not something which are ultra luxurious where you see tremendous amount of oversupply in that. Yes, I agree with your point that the velocity is not in line with what we typically see in a smaller town. But at the same time, I'm saying that it at least ensures that it keeps the machinery going and does not really add to tremendous amount of stress levels to us.
Okay, all right, sir. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Rakesh Jain from Jasper Capital. Please go ahead.
Hello. Hi, sir. Just a small question. What would be your gross yield and basically the segmental yield across the portfolio?
The yields, overall yields you are saying?
Yeah, as well as the segmental.
So overall, when you look at the portfolio level, it will be in the range of somewhere of 11.15 to 11.30. If I further break it up, home loans would be at 10 to 10.25. Loan against property would be between 12 to 12.5. Project finance would be between 13 to 13.5, and SME would be between 12 to 12.25. Giving us a blended yield in the range of 11.15 to 11.25.
So what are these SME clients basically, like SME portfolio consists of in a broad sense? How is the loans over there?
SME predominantly has three parts. One is plant and machinery. Second is property term loans, and third is medical equipment.
Okay. And what would be your builder portfolio? Means the funding that has been given to the builders over there in the CF book.
So overall, when you look from a portfolio perspective, I'll tell you, home loans is 59%, loan against property is 21%, project finance is 16%, and 4% is SME.
Okay. What did you say before 4%? I just missed that.
SME.
Okay. Thanks a lot.
Thank you. Next question is from the line of Nidesh Jain from Investec. Please go ahead.
There's a couple of data-related questions. One is what quantum of securitization income that we have booked in this quarter and the quarter last year, Q1 last year. Secondly, the breakup of fee income, if you can share this quarter and last quarter.
So securitization income, what we have booked is 72 crores.
This is the net incremental impact on the securitization income due to upfronting, Nidesh.
How much? 72 crores.
72 crores.
Yeah, compared to 53 crores in the Q1 of last financial year.
Yeah. And what is the next question you asked?
The breakup of fee income. A breakup of non-interest income.
Yeah. So basically, it consists of mainly the commission, that is insurance commission, and the processing fees on the retail. So the commission is 25 crore, around 25 crore, and the processing is 65 crore, and the remaining are some other charges. So this is totaling to 132 crore, which was 58 crore last quarter, corresponding quarter.
Sure. And in this accounting, there is no change under Ind AS, this 58 and 132 crores?
Yeah, there is no change, right.
And so secondly, on the interest rate scenario, so we have passed on almost, I think, 60 plus bips for our existing customers. So how is the competitive intensity? How is their behavior in terms of looking out for refinance, or how is your experience there?
qualitative and
So, see, there are two parts to this on the interest rates. One, on the interest rate increase, it does affect from a sentiment perspective. That because the interest rate has gone up, the question comes around affordability. But I think the more important in our scenario is again breaking up the interest rate to say that, look, it really does not come and impact your overall affordability in terms of servicing the EMIs. Because a 25 bips increase for a loan of a 15 lakh loan for a 20-year loan, the EMI change which happens is just about few hundred rupees. I would say it would be just about 150 to 200 rupees, which is not substantial given the fact that our FOIs are somewhere in the range of just about 50-55%. So it can easily absorb an increased EMI of 150 to 200 rupees. However, our first attempt is always to see how do we further increase the tenure so that keep the EMI same, as a result of which he doesn't see tremendous amount of stress in spite of the fact that the interest rate has gone up by 25 basis points. But what he still sees that is, in spite of the increase, he is still able to get a loan and go and buy the house which he always wanted to. Because the performance of the portfolio tells us that actually we will give out a loan for 20 years, but the churning and the closure of the loan happens by about 7 years.
Yeah. So that is on incremental business. On the existing business also, you must have increased the interest rates.
Yes, we have increased by 62 basis points. Yeah.
So is there any change in terms of repayment behavior, or we expect any change in future because of the increase in interest rate?
It is not that we have increased these interest rates in isolation. In fact, if you see that, the market leaders have done it first, all the big boys on the street, and then we have followed it up, and we were very cautious about it to ensure that, it is also done in a very smooth way. So, and we have done 3 such hikes over the last 4 months, and we have not experienced any such stress levels on that.
And then lastly, on the repayment rate also, we have noticed that this quarter, and if you look at last 2 to 3 quarters, there is some decline in repayment rate versus the historical trend. So have we done anything specific to have a focus on reducing balance transfer or to incentivize customer to stick with us?
Yeah, so I'll have Vivek respond to this because he's actually driving the entire, what we call it internally as the BT retention drive. So Vivek, maybe you can take that.
So a couple of points here. One is obviously internally we have now set up a very robust process of retaining customers who are coming for BT. And we also put in some predictive modeling to see what kind of propensity models exist and using that to proactively reach out to customers for retain. And this also includes multiple initiatives like pre-approved top-ups and reaching out to customers for additional benefits on the loan. That's point number one. The other, I think, is the fact that with the interest rates hardening, the amount of easy money available for some of these new incumbents who are driving this BT culture, now that elbow room has reduced. And I think that's a significant advantage for people like us who have had some historical book, because the elbow room doesn't exist with the yield curve the way it is, and that arbitrage has gone away. So a combination of both internal and external factors is why you see this declining, and that's in line with what I think we are also forecasting.
Thank you, sir. Very helpful. Thanks.
Thank you.
Thank you.
Next question is from the line of Sumit Chaudhary from Zaba Capital. Please go ahead.
Yes, hi guys. Congratulations on a good quarter. Just a couple of questions. First one, I noticed that your capital consumption has been almost 400 bits last year, and even in the first quarter, I guess it's almost 100 bits. So how should I think about how much capital you would need to consume? And related to that is the capital raise which you've announced. How should I, the 40 billion rupees raise, how much of a growth runway will it provide to you? For how many years will you be, taken care of in case this capital raise goes through?
Yeah, so basically it has 2-3 facets I must address. One is that if you look at our capital adequacy ratio, even at the whatever the I gap perspective, which we have already published in our PPT, is very comfortable. And going forward, when the index valuation comes, this will further go up. So from that perspective, we don't see there is any real urgency immediately. And then second thing is that, as you would have observed during the speech of Chairman and our Joint MD, that our strategy is to securitize the portfolio, and we would like to ramp it up more. So that would release the capital. So all that put together, if you look at, then currently we are well capitalized, but for future, whatever fund if it is required, that we will think it over. That is from my side, and maybe Bharat or Arsil can also contribute to this.
So the idea here is that as we grow and we continue to have this sustainable growth rate, we will make a point that we have enough capital as a part of our capital retention strategy. And as our growth picks up, we should have a sufficient capital. At the same time, Sarmaji especially mentioned, is that our strategy says that as going forward, I think capital consumption should drop compared to where we are. And we would like to have a well capitalized, and the capital raising plan which we have announced, it is in line with building capital buffer and making sure that we are well capitalized and ready to take any challenge, whatever comes.
And sorry, the capital consumption you're saying will come off because you will securitize more, right?
Absolutely.
And just on that point of securitization, I guess you mean DSA. So DSA, just so I'm very clear, the upfront revenues that you book on DSA sales under Ind AS, that's part of your NII line, right?
That's right.
So this will kind of fluctuate depending on which quarter you sell more or less of your portfolio. If you could also comment on how do you see the outlook of this direct assignment market, considering I would imagine a lot of financial institutions after Ind AS especially are looking to tap this market versus securitization, given the kind of boost it gives to capital and to income. How are you looking at the demand-supply situation and the spreads in this market incrementally?
So we have a well thought-out plan in terms of securitization. We have immigrated on this particular journey last year. We have ramped up our securitization last year, and current year we have a well thought-out plan. We have a process and business model in place where we believe that there will be some volatility in our securitization volume, which will result in marginal difference in terms of the upfront booking of income, but that should not be materially different. And as far as demand and supply is concerned, for a good quality asset, there is enough demand. It's just a matter of your ability to generate good quality assets and provide to the right institution who is looking for those kind of assets. And we believe that the assets which we generate have all the characteristics which is required for sell down.
And further to add to what Bharat said, there are strong PSU banks who are buying the portfolio, and they have the demand also going forward. So I think from demand perspective, there is a very good demand.
Understood. Okay. And what caused you, and again on the processing income, you said, if I got it correctly, for retail loans, you recognize the entire loan processing income upfront and the origination cost upfront, right?
That's right.
So the 65 crores, when you gave the split of your 132, the 65 crores retail processing fees is all the processing fees you've taken upfront. And what was the number in corresponding period last year? Basically, this would be a function of how your disbursement grows, right? This processing fees.
Not only disbursement, Sumit, while Santosh will give the number, not only disbursement, this is actually a function of the business that we generate from a login stage. See, processing fee is taken at the login stage, and is generally taken to cover the expenses of processing a loan. It's not necessary that the loan will be sanctioned, or if sanctioned, it will be disbursed.
See, the idea is, Vivek, the idea is this is a fee which is not linked to the disbursal of the loan, but this is a fee which is linked to a set of activities which occur towards the sanction and the subsequent disbursal of the loan. and it's the initial processing fee. So hence, as it's not linked to the approval rates or the disbursal of the loan, this is the one which is recognized upfront.
Sure, I'm sure you've given the justifications to your auditors as well.
Corresponding quarter processing fee was 31 crore.
Okay. And is it in line with industry practice, this upfronting of processing fees?
More or less, yes, because it is driven by, obviously, we are in a competitive market, so it is driven by what competitors do. So there could be upfronting. There are variants everywhere, but it's more or less in line with what at least the peer group does in terms of collecting.
Yeah, whatever we have information, I think across the industry, this is the practice being followed under Ind AS.
Okay, understood. All right, thanks, guys. Good luck.
Thank you. Next question is in the line of Nishchan Chawate from Kotak Securities. Please go ahead.
Hi, and congrats for a great set of numbers.
Mr. Chawate, may we request you to please speak a bit loud? Your voice is very faint.
Yeah, hi. Congrats on a great set of numbers. Yeah. Just wanted to, if you could repeat the breakup of fees of 132 crores. I think what you mentioned was that insurance commission fees was 25 crores. Just if you could kind of share the breakup again.
Yeah, so 25 crore is the commission, what I said, that is insurance commission. Processing fees is 65 crore, and rest is basically prepayment charges and other charges, those all put together. It's 132 crore.
Sure. Now, just one clarification. The loan sell down that you do, this is essentially a bilateral assignment, right? This is not a securitization.
That's direct assignment, yes.
You don't do any securitization at all?
We have not done it in this year or in the last year.
But as and when market opportunities are there and we believe the cost and the benefits are in our favor, we may not mind to do it, but it is all depend on the opportunity, investors, broadening of our investor base, giving us more opportunity to tap new markets. So it's all subject to depend on the market.
Now, if I have to look at your total loans under management, I mean, how much of it would be securitization and how much of it, basically the loans outside balance sheet, as we see today, how much of it could be securitization and how much of it could be?
There in our presentation, if you go through it, okay, it's there on slide number 33. The 17% of the AUM is off book. In terms of amounts, it's 199.6 billion INR.
That's right, but do we have, I'm just looking at the slide, do we have a breakup of securitization and assignment?
The securitization will be just maybe 5 to 6% of my total off-book exchange. It's not very much.
You don't know that, it's maybe very less.
But it's 5 to 6% of the total off-book, okay, so yeah. That's a very, very negligible amount.
Yes.
Yeah, sure. And incrementally, what would be the ratio? I think today securitization, as the loans outside balance sheet are around 17% of the total loans. So what ratio are you really looking at? I mean, as this kind of keeps on increasing over a period of time, do you intend that, to where can this ratio really go up to?
In terms of the off-book mix?
Yeah.
So we
total
have a target to take it to 20%. That's our medium-term target, and we are working on that line.
But as far as your question is that what would be the PTC and what would be the direct assignment, that at the moment we can't really say. Whatever demand we have, that demand is all for the direct assignment.
And any specific saving that you would get in the process, in terms of whether you buy it on the balance sheet whether you raise money on the balance sheet or whether you sell down as a direct assignment?
Which is, I think that would be, as we mentioned, even in the opening remarks, direct assignment obviously is quite beneficial from the perspective. It releases the entire capital, all credit losses are passed on, and the rate at which, we are able to sell down to the banks is pretty much in the range of their MCLR or even below MCLR after considering the servicing fees. So from that perspective, we believe direct assignment makes a lot of sense, and our effort is to maximize the volumes.
Sure. Great. Thank you very much and all the best.
Thank you.
Thank you. Next question is from the line of Wei Ling Lee from East Spring Investments. Please go ahead.
Hi, good afternoon to you. We'd like to ask whether we understand that you have brought down borrowing costs by spreading out your borrowings, but in the face of rising interest rate environment, how are you going to see? Do you see any compression in terms of your margins? And secondly, we see that there is a reduction in the proportion of housing loans. What is the reason for that? And lastly, do you see a rise in non-performing loans in the affordable housing loan space?
Yeah. To answer your questions, Wai Ling, is first is in the increasing interest rate scenario, and to protect the margins. If you see, we have balanced it out by increasing our interest rate on the portfolio as well, and also our incremental loans are also done at a higher rate to offset any increase we see in our cost of funds, thereby ensuring that we protect our margins. And that is our sole endeavor, to make sure that, whether it is a falling interest rate scenario or an increasing interest rate scenario, we have to ensure that we protect our margins, and our endeavor is around that. Over the last quarter itself, we have had done 3 rate increases, and in spite of that, we have still been able to post this kind of growth, which sort of tells you that, we are able to continue to grow and yet protect the margins. So that is number 1. Number 2, at the current stage on the loans which we are doing, we do not see stress as far as our portfolio is concerned. It continues to be healthy at 0.93, 0.94%. And even going forward, we are not seeing any undue stress around the portfolio. So this is how we look at it. I think I missed still one more question which I have not answered.
Actual percentage is down.
So yes, you are right with respect to how my composition on the home loans bit has come down. Now, there are 2 ways to look at this. While overall on my portfolio, home loan percentage is coming down, but in absolute terms, the home loan disbursements which we are still doing are increasing. It is not that the home loan disbursements are going down. What we are seeing is the percentage of LAP and SME which we are doing is increasing because of a smaller base. Second is also because of certain significant changes in the local economy, predominantly around with GST. We clearly see a formalization of an economy which is happening in the mid-segment, where we are leveraging on the opportunity which is coming to us, because this is a segment which is transitioning itself into a formal economy. And we believe that this is a good opportunity for us to onboard good credit while they transition themselves into a formal economy. So it gives us definitely a perception with respect to that the home loan share is coming down. It is the growth in the disbursements of the LAP and SME which is going up, but overall disbursements in the home loans is not slowing down. In fact, home loans standalone has posted a growth of 28%. So our home loans disbursements continue to be strong, but yes, your LAP and SME disbursements has grown up and has taken a share which has moved from under 20% to 20% in LAP and 4% in SME. So that's how we look at it. Because we believe that this is a transition. But like I said in my earlier opening remarks, that we are very clear that from the current 3/5 levels of home loans, we would like to take it to 2/3 levels over the next couple of years. I hope, Lee, this answers your question.
Yeah, thank you.
Yeah.
Thank you very much. The next question is from the line of Keyur Asher from Reliance Nippon Life Insurance. Please go ahead.
Thank you, and congratulations on a good quarter. Sir, in an earlier question, you gave us an idea about the blended yield on across product mixes. So, sir, wanted to understand what is about average transaction size across these product mixes, and also if you could give us a flavor on the loan to value that we are seeing.
Yes. So on the home loans, our ticket size is around at 17 lakh rupees. On the loan against property, we are somewhere in the range of 45 to 55 lakh rupees. On the project loans, we are somewhere in the close of 120 crores to 150 crores. And on the SME side, we are somewhere in the range of 85 to 1 crore.
And so regarding the loan to value?
Overall blend in the range of about 31 to 35 lakhs, including project finance.
This is on the incremental basis.
Okay. And sir, regarding the loan to value?
Loan to value home loans would be, just a minute. On the home loans, we would be in the range of 70 to 75%. On the LAP, around 45 to 50%. On the project finance, we would be at 35 to 40%. And SME would be about, close to 60%. 50 to 60%.
And to add on the home loans, anyways, we are regulatorily governed on the kind of loan to values that we have on the various ticket sizes. So our ticket sizes, obviously, our loan to value on the home loan will be slightly higher because of the lower ticket size. Because the permissible limit up to 30 lakhs is 90% of LTV, though we don't go there. But we are completely governed by the regulatory caps on LTV and are within that.
Thank you, sir. That was helpful.
Thank you. Next question is from the line of Prakhar Agarwal from Edelweiss Securities. Please go ahead.
Yeah, hi sir. 3 questions, broadly data keeping. First, in terms of disbursement breakup, if you could give me. Second, in terms of NPA between housing, LAP and project finance. And third is ZCB outstanding.
So I think the ZCB outstanding, before we get to the ZCB outstanding, maybe Vivek will take you through the NPA level.
Yeah, so NPA, we've reported a number of 0.93%. Which by various product categories, if you were to look at it, it's about 0.75 to 0.8 bips for home loans. It's about 1 to 1.1 for the LAP and the SME business is about close to 1 or less than that. And the project finance is between 1 to 1.15. So the blended number that you see is 0.93. And the home loans, if you go by the ticket sizes, we are very stable, and that's reflecting in the blended portfolio numbers also.
Yeah. So on the ZCB, the current outstanding is 1,800 crore, and against that, as we already covered in our speech, that all entire ZCB interest has been now booked through profit and loss account. So any specific question about ZCB?
No. And lastly, in terms of disbursements, composition of between housing, LAP and project finance and SME, disbursement breakup this quarter?
So home loans was 6,116 crores. Loan against property was 3,800 crores. Project finance was 2,559 crores. And SME was 1,108 crores, bringing the total to 13,583 crores.
And so one last question. What is your attachment rate of insurance that you're currently seeing?
Yeah, so there are multiple insurance which gets obviously sold to the product, but if you were to take the primary one, which is to do with fire and property, which is of primary essence from a collateral perspective, we are about 90% plus in terms of attachment rate during onboarding, and we also have during the life cycle engagement and cross-sell process. So at a portfolio level, we'll be anywhere between 90 to 93% on fire and protection. And the rest, depending on the nature, key person life insurance would be in the high 70s in terms of attachment rate, because there could be other insurers also for the same person. But fire and property, we are upwards of 90% at both incremental and portfolio level.
Okay, thank you so much. That is it.
Thank you very much. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments. Over to you.
Thank you, Zaid. Ladies and gentlemen, thank you very much for taking the time out and thank you for your continued support, comments. We value them and we continuously try to improve and try to see how we can make the most of it. Once again, on behalf of the entire team, DHFL, thank you very much and greetings on the eve of Independence Day. Jai Hind. Thank you very much. Bye.